Over the past few weeks, a palpable slowdown in the U.S. housing market has begun to ripple through multiple sectors, leaving industry insiders and investors on high alert. Mortgage rates have stayed stubbornly elevated, most recently hovering around 7.2%, according to a mid-December report by Freddie Mac, causing many prospective buyers to slam on the brakes. The result? Companies that count on robust home sales, from mortgage providers to furniture retailers, find themselves grappling with shifting consumer sentiment and shrinking demand. Mortgage lenders in the hot seat. Fresh data from the Mortgage Bankers Association, MBA, released on December 28 reveals that home purchase loan applications fell by about 15% compared to the same time last year. Lenders such as Rocket Mortgage and Wells Fargo Home Mortgage have flagged a noticeable downturn in new loan originations, attributing it to would-be buyers who are either waiting for rates to cool down or reassessing their financial readiness. Some have even floated the possibility of workforce reductions in the coming quarter as they contend with reduced volumes. It's not just big-name mortgage companies feeling the crunch. Smaller community banks and credit unions are also reporting tighter margins as they struggle to compete on interest rates and ancillary services. Analysts warn that if rates remain above 7% for the next 2 quarters, more lenders, particularly those with narrow profit margins, could be forced to scale back their operations. Online real estate platforms feeling the heat. Digital powerhouses like Zillow and Redfin are noticing shifts in consumer behavior as well. While website traffic remains relatively strong, fueled by homeowners trying to gauge their property's worth or potential buyers dreaming of a post-rate hike shopping spree, actual conversion into sales is falling behind last year's numbers. Zillow's latest market brief shows fewer active listings going under contract within the first 2 weeks, a key metric for measuring demand in desirable neighborhoods. Redfin, on the other hand, reports that average viewing times per listing have increased, indicating buyers are taking more time to compare options or simply window shopping without sealing the deal. Traditional brokerages caught in the crossfire. Compass and eXp Realty, 2 prominent brokerages that expanded rapidly during the booming market of 2021 to 2023, are also experiencing a decline in closed transactions. December closings were down approximately 10% month-over-month, according to preliminary year-end statements. While real estate professionals expect a seasonal slowdown around the holidays, this dip has proven more pronounced than usual, highlighting how higher interest rates and inflated home prices can conspire to keep buyers on the sidelines. Impact on builders and construction. The slowdown isn't limited to existing homes. The U.S. Census Bureau's early January data indicates that new housing starts in December fell by 9% compared to the previous month, an unusually steep one-month drop. Builders are exercising caution with speculative projects, opting to complete current developments rather than break ground on new ones. Construction supply companies, specializing in everything from lumber to roofing materials, are also reporting softer demand, as developers reassess inventory levels to avoid oversupply. Retail and home improvement sectors under pressure. One of the more immediate consequences of fewer home sales is a noticeable chill in home-related retail. Giants like Home Depot and Lowe's have shared that sales of high-ticket remodeling items, including kitchen cabinets and HVAC systems, have not met holiday forecasts. The National Association of Home Builders, NAB, underscores this trend, noting a dip in renovation permits issued across major metropolitan areas. Furniture and appliance sellers, too, are contending with lukewarm demand. According to a mid-December survey by the National Retail Federation, NRF, foot traffic in home furnishing stores is down roughly 8% versus the same period in 2024. Online purchases haven't picked up the slack either, as many buyers wait to see if the housing market stabilizes before making large discretionary buys. Consumer sentiment. Caution prevails. The Conference Board's Consumer Confidence Index for December reflected a slight dip from November's reading, suggesting that inflation worries and higher borrowing costs continue to weigh on household budgets. A subset of potential homebuyers is now leaning toward renting longer, hoping that either prices cool off or the Fed might signal more accommodative policies. Some industry observers speculate that this wait-and-see attitude could extend well into the first half of 2025, particularly if labor market uncertainties linger. What lies ahead? Market watchers are split on whether we'll see a spring rebound. On one side, Optimists point to the possibility of the Federal Reserve pausing rate hikes if inflation metrics continue to soften, which could reinvigorate buyer confidence. On the other side, skeptics argue that even a modest drop in mortgage rates might not be enough to substantially bring down monthly payments for buyers stretched by elevated home prices. Plus, looming questions about global economic stability, particularly in Europe and Asia, could keep U.S. investors in a defensive stance. For businesses tied to real estate transactions, the current landscape calls for adaptability. Lenders are revising their product mixes, brokerages are focusing on leaner, tech-driven models, and retailers are betting on targeted promotions to entice hesitant consumers. Some big-box stores have begun partnering with buy now, pay later services in an effort to lower the barrier for large home improvement projects. Meanwhile, smaller players are bracing for more volatility, emphasizing agile inventory management and cost controls. Bottom line, as mortgage rates remain elevated and potential homebuyers bide their time, companies that thrive on a bustling housing market are testing new strategies to ride out the downturn. From lenders trimming overhead costs to builders delaying new projects, the ripple effects are set to continue over the coming months. Whether a more pronounced market thaw arrives in the spring or later in 2025, the housing sector's shift toward caution underscores just how interconnected these industries really are, and how higher rates and economic uncertainty can reshape consumer behavior in the blink of an eye.